It's fascinating to see the decision-making process of investors when they begin to contemplate selling their stocks as their portfolios begin to go down. Most of the time, the stocks they are selling are amazing companies that have strong balance sheets and amazing fundamentals. However, when the broader market begins to sell off, this can have an effect on those strong businesses, even though nothing has changed with them fundamentally as a company. Most investors fear opening up their brokerage accounts and seeing in bright red numbers the losses that have incurred to their portfolios. Overwhelming fear begins to consume them as they start initiating sell orders to sell their stocks at a loss. They know that these are strong businesses, but they are afraid that the losses will continue, so they decide to sell and cut their losses. This is completely the wrong mindset for investing. It seems so simple, but yet so hard to execute. So many people say they are going to invest for the long term, but when they begin to see their stocks down 30%, they begin to panic and think that their investment can go down even further. And it's true, it can. However, will they continue to go down 3 years in the future? Probably not. If it's a strong fundamental business, it will most likely be much higher in the future. In order to never lose money in the stock market, there are 3 factors you must abide by. Number 1, invest for the long term. Only invest money that you do not need in the short term. When you do this, you will not worry about whether the stocks go up in price or down in price short term. You are expecting to hold these companies for 3 to 5 to maybe even 10 years in the future. If you have this type of mindset, the stock price that you see today won't make you cause to have an emotional response to sell your stocks. Just recently, with economic conditions being very volatile, some of my stocks in my portfolio have been down 20-30%, but I am not worried, not one bit whatsoever, because I know that these companies are strong fundamental companies that will appreciate in the future long term. So to me, this is a big fire sale to invest in high quality companies. Number 2, look for companies with strong fundamentals. Strong fundamentals in a company are those that have good balance sheets and or a lot of growth ahead of them in the future. So for example, let's say you buy Microsoft and it immediately goes down in price by like 20%. For most stocks, this would be devastating. But for Microsoft, it is an amazing company, and it being down 20% would be a great opportunity to buy more shares. Number 3, dollar cost average. It hasn't been said enough. Dollar cost averaging is one of the greatest strategies to use whenever you're investing. When you see a stock price go down, try and look at it as not losing money, but as a discount to buy more shares, or dollar cost average. If stock drops by 15%, think of it as a 15% discount for you to buy more shares. This will help you from having to time the market perfectly, since it's virtually impossible to do so. Dollar cost averaging gets you real close to the lowest cost basis possible when a stock is trending down, and you will ultimately come out ahead long term. When you utilize all 3 factors together in your investment portfolio, it can give you the mindset and tools to never have to lose money in the stock market. However, you have to utilize all 3 factors in your strategy. If you don't invest for the long term, you'll be tempted by short-term decision making and may sell out of all of your stocks due to fear. Recently, this is a good example due to the market conditions in the economy right now. If you do not pick a company with strong fundamentals, the company may degrade to where it was not the same company you invested in at the time. If you don't dollar cost average, bad timing can make you want to sell out the stock in order to get back to a better cost basis. This type of mindset is not perfect, but it has truly helped me get through short-term unrealized losses in my portfolio. When you see your stocks are down by 15, 20, or even 30%, it can be really hard to accept, and you may even question your investment strategy. However, unrealized gain or loss is exactly how it is described: unrealized and not an actual profit or loss. You only realize profit or loss when you sell, and if you utilize all three factors I listed, you will not have to sell for a loss and will never lose money in the stock market. Please leave a like if you enjoyed this video or found it informational. Also, please subscribe to see my upcoming new videos, which I will be posting every day, where I keep you updated on investment opportunities that will lead you to your financial endeavors.